Good to go, Bill.
Great. My name is Bill Bymel. I'm the founder of First Lien Capital. I've got about a 20-year career in real estate. My involvement in commercial real estate started in 2005 when I sold my first CVS as a broker on LoopNet in 24 hours. Subsequently, I've invested in multiple classes, both personally and as part of funds and partnerships, mostly in the retail, mixed use, and multifamily sector. I spent the last 10 years managing assets on behalf of Spurs Capital. We're an investment manager in the mortgage space, and I recently stepped down as an active director there. I remain an advisory and signatory to multiple funds, but I just founded First Lien Capital, again, with the strategy to buy non-performing, sub-performing first lien mortgages on the secondary market. But since I've been involved mostly in Resi NPL the last year, I'm going to ask the questions today as opposed to answer a lot of them. What I'd like to do is introduce each of our panelists. We have a great class. I'll give them each a minute or two to say hello, and then we'll jump into some questions. Let's start with Laurent Massa. Hello, Laurent. How are you?
Good. How are you, Bill?
Great.
So a little background on me. My name is Laurent Massa. I am the Associate Vice President at Group RMC for the Family Office and Advisor Relations Division. Quick background on myself and Group RMC. So essentially what we are is, we're a group of families who get together and we buy commercial real estate, specifically office, in non-gateway U.S. cities in the Midwest and the Southeast. So it's a very specific pocket of real estate, but that's really our niche. And, alongside our families, we do have a good contingency of professional athletes who invest with us. And that's sort of my division of the business, given that, permanent hard assets are a good fit with professional athletes.
Yeah,
and so
very cool. Very cool. I'm sure there's going to be a lot of questions about office. It's been an asset class in commercial that has had a lot of us scratching our head, even pre-pandemic, but certainly now post. So I look forward to getting into questions with you. Doc Sangani, good morning. Say hello.
Hey, good morning, everybody. I'm a cardiologist by profession and have a family office that is primarily investing in real estate, private equity opportunities, and operating companies. And at this point, we have approximately $1.5 billion worth of assets that we own and manage. Some of that we own outright 100%, and some of them is syndicated. And we have a significant presence in Israel stock market with our bond company, and very happy to be here today.
Very good, and we're glad to have you. We're going to be asking you questions about multifamily. I think you've got some dabbles in the hospitality space as well. I'm going to hit you up there. Gideon Pfeffer, hello. Good morning.
Hey, good morning, Bill and everyone. My name is Gideon Pfeffer, and I'm the managing partner at GSH Group. We're a real estate investment firm focused primarily on multifamily residential. We have a huge presence in the Midwest. We love focusing on secondary and tertiary markets. We're more cash flow driven. Our typical investor is kind of in it for the long haul. They want to put their money to work and achieve superior returns, less speculative, more payment up front right on the onset of any investment. We operate heavily in the ESG world and provide that component for investors who that is important to. I'm looking forward to this conversation.
Very nice. And I also noticed reading your background, you've got some bulk REO rental experience, so I may hit you up on some of that area as well. Last but not least, Eric Berman, Lifeafar Capital. Say hello.
Morning, everyone. Eric Berman from Lifeafar Capital. I think today I'm the representative for the hotel hospitality sector on the panel. Our group is a vertically integrated hospitality real estate firm. We do private equity development, as well as we have a management group, and we're focused in the US, and we have a few investments internationally. In the US, we're predominantly in Puerto Rico, and we actually structure single asset opportunity zone funds. So we look to leverage different tax benefits and advantages here on the island in Puerto Rico, as well as the federal op zone legislation. There's been a lot of discussion recently in the hotel world, and it's, you know, the hardest hit. And I think it's going to be exciting to talk a little bit about the future of the industry and the opportunities we're seeing in the hotel sector. So looking forward to the panel today.
That's great. That's great. I'm actually going to hit you up with the first question. So you're one of the many that have jumped ship down to Puerto Rico. You like the tax advantages and you love the weather, I'm assuming. So I have a lot of friends that have followed in your suit, Eric. While I have you, let's talk about hotels, because that's really your space, and I think the hospitality asset class is a very intriguing one. And the topic of today is opportunities in mixed CRE, and we're really focused on what's the status coming in as a result of the pandemic and what new opportunities lie ahead. By the way, I encourage anyone participating live to get involved. If we want to get granular and get into what is a very broad range of topics, if any of you have specific questions, there's a Q&A button below. Jeremy and myself will be monitoring it, and we'll make sure that we answer live any questions that you have, just as a reminder. So where hotels seem to have been one of the hardest hit asset classes, at least, you know, some roller coaster effect that's gone on here. Talk about the landscape of hotel deals. What's changed as a result of the pandemic, and what are you seeing in the months ahead for hospitality?
Yeah, so we could have a long conversation about the different types of acquisition opportunities, whether it's new construction versus acquisition and renovation, repositionings, distressed asset or distressed loan purchases. I think there are a lot of macroeconomical factors and just sources of the environment. For example, if you're in construction, construction costs are rising. It's no secret that there are logistical issues with, you know, shipping materials across the world, and that's getting more expensive. Labor is getting more expensive in certain areas. Most of the opportunities seem to be shifting toward, at least in the institutional world, the more simple, easier to grasp their minds around an acquisition or stepping into a distressed or troubled situation, usually with a flag attached to it, where either the borrower is in forbearance and someone's looking to come in and help them out and restructure and jump into the situation. And I think that if you back up to the beginning of the pandemic, when there was so much uncertainty and no one knew what was going on in the world, everyone just assumed that everyone would be going bankrupt in the hotel world, and there would be a whole lot of, you know, Chapter 11s and walking into those situations and picking up assets at pennies on the dollar. But that hasn't been the case, and I think that hasn't been the case to date because of forbearances, and it's in the best interest and preference of most lenders to try to work something out. You know, they're not in the business of taking the keys and being operators. So I think they're understanding and they're trying to work things out.
So does that hint at the possibility that there's still a bunch of stress in hotel loans that we haven't seen because of the forbearance and the general sentiment of the last year?
I think so. I firmly believe so. We're kind of coming up on the point where I think lenders are going to have to make a decision. Do we continue to forbear? Do we, you know,
Right.
take a haircut and restructure, or do we step in? Right. And
Right.
I think inevitably there are going to be a larger number of deals coming through that pipeline over the next 6 months, 6 to 12 months, let's say.
Yeah, I agree with you. And I'm going to come to Doc next because you've got a hospitality background. I want you to follow up on this, but I do want to point out just on what you're saying there, Eric, you know, the CARES Act allowed there's a small provision with regard to TDR and CECL reporting. These are accounting standards that the banks and large institutions were required after the last crash. They had to be more transparent about what's not working, what's troubled debt. And because of the CARES Act allowing these larger institutions to not report or underreport if they choose to, we all don't know what exists at many of these banks. So I just want you to keep that in mind. Doc, talk to me about hospitality.
So no, I think I share most of the views that Eric mentioned, but I think there is a little uh, bifurcation of who is going to be in trouble and who is not. And if you really look at it, when the pandemic hit and the ADR and the RevPAR went down and they were non-sustainable, 10% occupancy, 15% occupancy just wouldn't work. But what has happened over a period of time, because of the stimulus and PPP money and all that kind of money, these hotels, either just like Eric mentioned, whether the forbearance agreement or whether the lenders, private lenders didn't want to take over the assets, they worked with uh, owners, and not a lot of distress was seen. And we all expected, actually we created a fund just to have distressed hotel investment, but we couldn't find enough distressed hotels. And then we said, okay, we'll wait. Well, what is now happening is, if you looked at it, the airline travel, normal travel is 2.2 million people a day. And during the last holiday, we actually traveled 1.5 million people travel. So I think what is happening is that slowly the RevPAR and the occupancy and it is coming back. ADR is following right after that. So as soon as the business travel opens up, which is again a factor of vaccination. So I personally believe that if you take the gateway cities, which are in dire trouble because they were bought at the wrong price, rest of the drive to market, we have a significant size portfolio, few thousand hotel rooms in our portfolio. And I'm very happy to report here that for 2021, we are projecting break even. In fact, last month was the first month that we did not have to fund $1, and that is without considering PPP money. So when you add PPP money, we are projecting 2021 to be neutral. And that's my president telling me it's neutral, because he always sandbags, so he doesn't need to report to the board. So I really think if Glenn is listening, he's going to be upset with me. But I really think we are going to make profit this year. And I think as the airplane travel and everything opens up, so I'm much more optimistic that the distress word that we've been keep talking about, it in a larger term will not happen, but it will happen in pockets where a very unusual pricing were paid in the pre-pandemic area.
Right. No, that's a good look.
So if I can add to that and follow up. Following up on what Doc said, I mean, back in 2015 and 16, it was I think the highest transaction volume in the hotel space through the cycle. And so all of those acquisitions and transactions that took on five-year loan notes, those were coming due anyway in 2021. And it kind of hit at the worst time. The pandemic kind of hit us at the worst time when lending dried up and all the credit markets, ran for the hills in terms of hospitality.
Right.
Now I think the sentiment from lenders is that there's kind of a shortage of deals, and they're starting to see that if you want to get involved in good deals and pick them up, you've got to come off the sidelines. You've got to be the first to act, because if you wait too long, the deals are going to be gone. And so I think that both investors on the equity and debt side are looking at the hospitality market with a lot more optimism today.
Mm-hmm.
Very true, very true. In fact, if I can say one more thing, if you don't mind, Bill.
No problem.
So Keith Thompson, who is one of our good friend and a great broker company in hospitality right after HWE, he was talking to me just last week, and he said he has never in his history seen number of deals on the market without much discount. They're probably somewhere between 5 to 15% discount. Number of deals on the market and number of buyers. That means essentially it's a seller and buyer's market today. And it never has happened in his entire career of 40 years. So I think Eric is very much correct. I mean, people have significant amount of cash because the interest rates are low. So they want to buy up everything. People are selling at a minimal discount. So, I mean, it's a very we have never been in this kind of situation in hospitality industry that we have been in the past 12 months.
Interesting. Very interesting. I guess printing $6 trillion helps make things feel good, right? So of course I have to be cynical. Gideon Pfeffer, I have a question for you. You are a multifamily investor. Talk about your geographic investment focuses. Where you come from? Has anything changed during the pandemic, and what you're up to these days in that world?
Yeah, sure, Bill. I feel, kind of torn in this conversation because, there's a part of me that, obviously I don't wish any distress on anyone, but there's always part of me, who's paying attention when there's global events and saying, are there going to be better deals out there? And in the multifamily world, we saw some COVID pricing maybe mid-year 2020 on deals that were kind of already under negotiation, already listed, already under contract because of the uncertainty. But by the third quarter of 2020, things kind of went back to normal, at least in my world, as it relates to limited discounts, a very seller-friendly market, maybe even more, limited deal flow on the outside as an active buyer. GSH considers itself a net buyer, even though we did have some. We do sell. So, prior to the pandemic, a lot of focus was on kind of warmer climates, the Sun Belt, gateway cities that was mentioned before. Not our focus, but just maybe more institutional equity. And what we found through last year was that, our model was always kind of slow and steady, high cash flow yields, a big focus on the Midwest, a big focus on secondary and tertiary markets. And all of a sudden, a lot of equity started looking at the same thing. It made us look smart. I'm trying to figure out, would I rather be smart or rather be lucky? And I think maybe I'm a little bit of both, but what I feel is that over the course of the last decade, at least since 2010, 2011, there was such a high focus on multifamily and a high focus on speculative investment. Speculative, has maybe a dirty connotation, but really what I mean is development and maybe like 3 to 5 year deal flow, or get in, add value and sell. And now I think that there's a little bit of stress or strain on that business model, and folks are looking for slow and steady and more yield driven investments rather than speculative IRR only deals. And so we're finding that the Midwest and these secondary or tertiary markets, the non-name brand markets, are very strong. They continue to be strong. So our focus, like I said, has been in the Midwest because we like yield, but we branched out into the Southeast and the Mid-Atlantic and Texas, especially that. Sometimes in the Midwest you feel like you're running uphill. And sometimes in the Southeast, it feels like the wind's at your back. So, having a good, differentiation is beneficial for anybody's portfolio.
Have you done any, I'm sure you have, but like demographically, how the Midwest has it been affected differently than the Southeast? And does that have something to do with it too, that you've got maybe some, more of a migration to warmer climates, or maybe the Midwest struggled more? Have you seen anything in that regard as it relates to pockets of the country in your world?
Yeah. Surprisingly, the areas that we invest in the Midwest, states like Michigan, Indiana, Ohio, are kind of population neutral. You don't have the strong population growth numbers as you do in the Southeast and the Sun Belt, warmer climates. And I think that the population trends have stayed relatively constant. I think that 2020 or the last 12 months is really just a blip if there have been any change. But what we did see is that Midwestern markets performed exceptionally well as it relates to rent collection, as compared to some of the other sunnier, warmer climates that have been kind of up until this point, considered stronger or safer bets. Our markets in the Detroit metro area and Indianapolis have some of the best rent retention and rent collection numbers in the country, and that's based on, not my data, stuff you can pull off CBRE's website and that.
That's really great stuff. I was at dinner last night with a gentleman, a friend of mine, who's got 40, 50 years in the commercial real estate investment space, especially multifamily. And he and a partner put a 200-unit deal on the market a few weeks ago in Phoenix, and they got 40 offers in like a week. 40 offers. He says he'd never seen anything like it. It speaks to what Bharat, what Doc was saying in terms of this, like, it's just so much money and so much action in the market.
I think there's a perception that, equities are overvalued at the moment, and real estate is a safe bet long-term, right? And there's a lot of dry powder out there. And I mean, I've seen that type of seller-friendly statistics, at least in my world, for over 5 years. And I think there's a lot of factors, but interest rates have stayed very low, and so the money's cheap, and there's a lot of money on the sidelines. So there's a lot of buyers. Great.
Yeah, no, I got a lot more follow-up questions for the three of you, but I want to get to Laurent. We don't want to leave out the office guy. It's important we get some office perspective. I've been following you, not you personally, Laurent, I'm not a stalker, but Group RMC. And you guys, it's interesting. When everyone else ran for the hills in the office sector last year, you guys started getting pretty aggressive. So why don't you talk about your whole investment strategy, permanent, how you guys do it, and why you think, give us a case for office right now.
Sure. Warren Buffett has a good quote. He says, be greedy when others are fearful, and be fearful when others are greedy. And I think that's a motto we kind of live by. We try to stay away from crowds, right? Because a lot of times what drives up, prices in certain markets, mainly gateway markets, is not the intrinsic value of the asset. It's really transactions. And in markets where there's a lot of transactions, where, the big institutions are operating, we're seeing things that are just too overpriced. And what Gideon's talking about is music to my ears, because it's really, we're invested in the same markets. Every state he mentioned, that's where we are. We're in the office space, he's in multi, but fundamentals are fundamentals. And since day one, we bought our first asset in the US in 2011 in Fort Wayne, Indiana. And that was just because that wasn't a sexy market, but the fundamentals were good. And to take a step back, our strategy is, we essentially see real estate as a permanent asset class. We don't see it as something that we should be churning and buying and unwinding our fund after 5, 7, or 10 years for some arbitrary deadline to collect a performance fee based on IRR. Like Gideon's saying, we're very cash flow, very cash on cash driven, not so much IRR. We're looking for yield, and these are the markets find it. We're finding 7 to 10, or pre-pandemic, we were finding 7 to 10 cap on in-place metrics, and in real estate, a lot of the value happens to buy. And so our strategy is to come in at a very low basis, essentially get all our equity out in the first 10 years through, distributions and refinancing, and then still own the asset. And that's how we get our liquidity. So, these funds who operate with arbitrary, wind down dates, we're happy to sell our assets. I mean, since we've bought in 2011, we haven't sold one asset because we're not bound by a term. That's just the way we're structured.
Interesting.
So,
and just as a general rule, you're in charge of raising money for your purchases. So, and I'm not sure what your history is, but what's the sentiment been of LPs coming into the space? Have you had more caution, or are there people saying, wow, we actually do see what you see, and we see it as a once in a generation opportunity to get into this class? Or what's the general sentiment? Is it kind of 50-50?
Yeah, so there's definitely been some caution. A lot of our partners are repeat investors, and they've been with us since day one. They know that, again, we're not some blind pool who needs to do a deal just to do a deal. So if we don't want to do a deal, we don't do one. So I know it sounds cheesy, but we don't do bad deals just because we don't have to do any deals if we don't want to. We've gone 5-6 years without buying anything because the timing wasn't right. I think the sentiment, of people being fearful of office, there is definitely a lot of truth to that, for sure. But I think behind that, what people fail to make the distinction between gateway and non-gateway cities. And
Mhm.
again, Gideon was alluding to rent collection and all that. Across our portfolio of 20 million square feet, we have a 98% rent collection since the beginning of the pandemic. And why is that? Well, it's the markets that we're in. If I think cutting rent is a very easy way for an executive to cut costs. But if you're going to do that, you're looking at your head office in New York City or in San Francisco charging $250 a foot. You're not looking at your regional headquarters in Cincinnati or in Columbus or in Kansas City charging $25 a foot. That's not going to move the needle. And so, also, another interesting point is social distancing has actually had us, we've seen a net increase in demand for space because not only are they not downsizing, but they have to respect social distancing measures now. So I think those things are pretty comforting to our investors who see our markets as fundamentally just different from gateway and more coastal cities.
Very good. Interesting. Great. Thank you for that. I want to come back to my cynical comment about the $6 trillion of government money printing. And really, because my friend Camille put a great question on the board, and I think it's really sentiment of many of the attendees and investors that I talk to, which is this concern that we are living in a false economy right now. Between the kick the can down the road forbearance, you can't evict, you can't foreclose, there's no TDR, CECL, there's no way to really know what stress level exists in the market. And at the same time, we're printing money and putting PPP and everything in place. It's hard to believe that this market is real because of those two factors. And so let's start with the hospitality, and I'll let Doc go first because I know he wants to answer this question. Is how do you really value things when it's not really clear where we're headed and what the true metrics of our economy are? Doc, talk to it.
Well, two things. One of the not participant, but one of the audience member has asked a question that
Right.
the vaccination is not permanent. And as a physician, Bill, if I can just take a moment to address that.
Please do.
So it is a very interesting situation. And then I want to take the fear out of people's mind about vaccination. If you really look at it, vaccination was initially good for 3 months because we only had the data for 3 months. Where last month, we just found out that the vaccination is good for 6 months because now we have data for 6 months. So if you go with the history of vaccination, I personally believe that this will eventually evolve into similarly like influenza vaccine. It'll be good for a year, new variants will come, and the new variants will be injected again in human body, and it will be just like fighting with flu. So I want to give comfort to the audience that don't underestimate the power of vaccination. It is curing the community. Just think about it. Even though there is a big hoopla about cases going up, variants coming up, number of deaths is slightly more than before, it is nowhere close to the peak. Why is that? If most of the states are opened up, why aren't we seeing deaths in thousands? The reason again is vaccination. We have covered almost 75 to 80% of the United States population, which is at risk. Overall, we covered 37, 38% is the last number. But of the people at risk, we have covered almost 75 to 78%. And that's why we are not seeing the increase in these numbers that even though we are all over. If you come to Texas or Mississippi, which is both states I am in, people are just mingling without any restrictions in Florida. So I just want to take that fear away from people. As far as hospitality and how to value, I just want to make a statement that, listen, 2007, 2008 taught us one thing, that interest rates and stimulus makes wonders. So, and just like Bill, you mentioned, people don't have to do mark to market while in crisis. So when
Right.
banks don't have to do mark to market, they are going to wait till the numbers come back. And as I said, the vaccination impact starts, people start traveling, and a very good seminar is there on the Walter Walker Dunlap series, that
Hmm.
even though we say, and Laurent would love to hear this from me because he probably believes in this, that we believe the office sector is killed because business travel is going to go away because of Zoom. That is not true. People in a competitive world, people would want to travel and show that he's better than the other guy. I already am having lots of
Right.
meetings face to face happening. So when the travel comes back, so I think hospitality should be evaluated just the way we normally evaluate. And I think the stimulus will stay. We have now found a way to keep printing money and keep pushing. We'll do it for 5 more years or 10 more
Oh
years,
boy.
whatever it takes. But I think the market is not going to, unless a third outside the United States event, a war or any of the bigger issues that comes up, is beyond our control. But
Right.
within our ability, I personally, and again, I'm a cardiologist, I'm not an economist, just my 2 cents.
I love the optimism, Doc. I want to address a couple things you said. First of all, I got my double vax and I feel like a whole new man. So, out and about. I mean, I live in California where everything's been shut down. It's not like Florida. And so there is a general sentiment amongst those of us that are getting vaccinated that we are coming out of our shell. It's a new day, etc. I think that the Camille's comment, though, was not just about the vaccine itself, but that there's an entire population in this country and outside of this country that is choosing not to get the vaccine. And what would be the effect of that, do you think, long term from a medical perspective?
Again, God bless them, people who are not taking it, and I just blame us, the health community. We have not done a good job educating people. If the social media can educate somebody not to take vaccine, we should be in a much more powerful position to educate people that vaccine is good for you. But put that discussion aside, it's for a different day. So what is going to happen? First of all, the population that is going to get infected. I mean, that is without question. No matter how much vaccination you do, everybody on the earth is going to get infected one way or the other, or exposed if not infected. So the question to start with is 99% of the people are not going to die, 99% of the people. So it's really, whatever is there, 85% of the people who has not taken vaccine and who will be exposed will have no symptoms. They won't even know that they are exposed to this. After the 15%, of 14% are not going to die. They're going to have some symptoms. So I don't think the overall impact is going to be that bad, but hopefully with time that naysayers will convert into yesayers.
Got it.
Can I jump in and talk just
Please.
like from a practical real estate perspective? You were talking
Yes.
about stimulus and the like. I think what we saw some differences in the second quarter of 2020, different than 2008, 2009, 2010. And the first one that we saw was that, at least from our perspective in the multifamily world, every single lender that I had a proactive forbearance plan for owners. I deal with kind of Fannie Mae, Freddie Mac, and some larger banks like SunTrust and some others, but not really CMBS lending. But I think that's a big difference from the larger financial crisis from a decade ago, where they didn't want to repeat the past, right? They wanted to work with us. Now we didn't take any forbearance. We didn't have to, and I think that's because of a lot of different factors. Some that I'm in the housing sector, so I think from my perspective, people value their house and the roof over their head, greater on the totem pole of their monthly expenses, perhaps. And so they want to make sure that is safe and they're making the rent payments. But we have benefited from, the various forms of stimulus because our some of our residents who stayed in communication and expressed hardship because of unemployment, because of specifically of the pandemic, were able to qualify for stimulus money, in the first round, kind of towards the middle of last year. And we saw an uptick we saw an uptick in rent collections around that time. And we've seen an uptick in rent collections this first quarter of 2021 once it happened again, and people started getting their stimulus money. So I'm not an economist, and I'm not going to speak to if it's positive or negative that that there is all of the stimulus money out there. But I will say that I believe that it is helping those most.
Right. I think that's important that you brought that up. Yeah, that's great, Gideon. That's really great, because this is exactly the kind of thing a panel like this is for. Somebody who's on the front lines and can tell you, yes, every time PPP is released, all of a sudden our rent collections go up. So because there's, everyone's been saying, oh, we're still collecting 80% or 90%. And it has to do with the PPP, I would think, and some of the other stimulus measures in place.
Just to add that, Bill, we are the largest Five Guys burgers and fries franchisee in the country. And let me tell you, every time this stimulus money has come up, our revenues have gone up above budget significantly. So I am a living proof that stimulus has helped.
Rent and then burgers, I guess. Or maybe vice versa, I'm not sure.
That's great. Well, so then it begs the question: what happens if we? I mean, we can't print money forever. We're going to be Argentina, So at what point? How do we work our way out? How do we go back to free market society? That's just a general question, more of a common rhetorical question. Well, let's talk about the shift of paradigm, and then I'll start with Laurent, and then we're going to go around the horn on the asset classes here. Because there's no doubt, and I think Matt brought it up and Camille brought it up, a lot of people think that there is a new normal in terms of the way we operate. People work from home, they're comfortable with Zoom. Yes, I agree. I want to get back out there and do live meetings. I plan to be traveling again soon. But I love the fact that I can meet with New York, Florida, London, and Tokyo all in a 5-hour period sitting at this desk. So it's like, there's some benefits to that. And I think it's creating a new normal in business. And so to that effect, how do you see that affecting your asset class? You haven't necessarily seen it yet. We've seen a lot of PPPs paying the office rents, I'm sure. But what happens when that dries up? What happens as businesses start to take a percentage of their offices, offline because of work from home? Talk about it from the office perspective first, Laurent.
Well, definitely there's definitely, I wouldn't call it a shift, but we're definitely adding work from home and Zoom, to our repertoire. I don't think, it's going to entirely replace office. I think humans by nature are very social creatures. I think that early on in the pandemic, it was kind of revelation. Wow, this is great. We can work from home. This is awesome. But I don't think it's going to, I know it's not going to replace office. I think at the end of the day, we are humans. We thrive on social interaction. And it is impossible to establish and maintain a corporate culture when employees are just a line item on a payroll, and then you have too much rollover, and it becomes much easier to fire someone or to hire someone, for $5,000 less in salary if they're just a number on your payroll. I think definitely, I alluded to it earlier, gateway cities have got it worse because you do have very dense floor plates. And I think just overall, you're seeing in California, right? The exodus from California. People are kind of sick of the high cost of living, high taxes, high density cities, and they're moving towards places like Jacksonville, Florida, which has seen the highest net increase in population since the beginning of the pandemic. I use that example because we bought Bank of America Tower last year, which is the tallest office tower in Jacksonville, Florida. And we bought it for 80% below replacement cost. In other words, 20% of the price of new construction, because a group was over-levered and undercapitalized, and they needed to sell. I mean, right now, if you're selling, it's not because you want to, it's because you have to. And so we saw it as an opportunity to essentially just go on offense. before the pandemic, from our perspective, we positioned ourselves in a nutshell. Our business is really being liquidity providers to institutions who need to unwind every asset in their fund. And they have, a component that's in the Midwest and the Southeast that maybe doesn't have as many buyers for it, which is why we're able to get such high cap rates. So that was an environment, still a buyer's market where there was 4 sellers with limited buyers. Now what you're seeing is 4 sellers with scared buyers. And that's just better for us because, we're a very well capitalized group. We have a very good reputation. We always close, we don't retrade. And so that there's a lot of value in that. Oftentimes, we're awarded a deal and we're not the highest bidder because, based on our reputation.
That's
and
great.
that's immediately accretive to our investors. And so I think that the narrative, I just want to go back to one point I mentioned early on, the narrative is true. Definitely, there is a paradigm shift in office, but there is such an important distinction to be made between non-gateway and gateway cities. The fundamentals are just completely different.
Right. And if you can get a quality asset like the B of A building in downtown Jacksonville, for 20 cents on the dollar, or, you're not going to get hurt, I don't think. Unless someone bombs Jacksonville, I guess. I followed that deal. I thought that was a great deal. Let me go to Eric on this same point about the shift in the paradigm and what your outlook on the tourism industry is, because we have one of our audience mentioned the fact that their perspective is there's going to be this kind of rush to get back out, and the summer should be great for tourism this year, maybe all the way through the end of the year, but that in general businesses, because of the Zoom, because of that, there'll be less business travel for the long term. And I don't know what your take on it is. Give us your outlook for the next 12, 24, 36 months.
So I'm really glad that Laurent said something he did actually, in that humans are social creatures, because I love this topic. And I feel that humans have an existential need to vacation and to travel and to have experiences like that. And that goes across both personal life and vacation, and also corporate travel. This also ties into our conversation about valuation. How do you value assets right now, right? There are a lot of hotels on the market, aside from those in distress, that are selling at no discount at all, perhaps even a premium. Throughout the pandemic, there are luxury resorts that have villas or a residential component that have performed better than they ever have before, that have been at 95% occupancy throughout the pandemic, because they've had people from gateway cities, New York and Los Angeles, coming down and just hunkering down there for months. So when we split apart, leisure travel versus corporate travel, I do think that corporate travel will come back slower, right? Big box hotels that depend on a lot of revenue and have a lot of OpEx for maintaining these banquet halls, there's going to be a lack in large conferences and get-togethers for a time. Hotels will have to reinvent themselves a little bit and get creative in how they utilize that space and bring revenue in. But on the leisure side, I think there are certain markets that are poised for stronger business than ever. I really think that people are going to place a heavier reliance on experiences and service, and they're going to expect a lot from hotels. And I think it's up to us to make sure that we provide the right service and are ready to take on travel and welcome people back the right way.
Doc, you agree with that, I'm sure. As a man that owns a portfolio of hotels, I'm sure you're in that vein, right?
and we are seeing it already. As I told you, we are break even and probably profitable this year, which is, we never thought. In March of 2020, hell, I did not know what was going to happen. This is a very pleasant surprise.
Oops, I muted myself. And Gideon, did you want to speak you kind of started us off with the free money conversation. Do you have anything else to add on the multifamily sector in terms of, I think multifamily certainly is or any kind of residential probably is one of the better suited coming out of this, because we've revalued what it means to have a home, right? We now no longer just sleep there. We do everything.
From like a marketing perspective, I if you put two equal properties in terms of return, and location next to one another, I would probably value separate entrances more than, hallway style. We're looking at, in-unit washer and dryers and great internet services and things like that. Just little nuances to each asset that might seem a little bit more interesting to a prospective tenant. But ultimately, I agree with what has been said.
Right. That's good stuff. Okay, so we got about 10 minutes left, and I want to take some questions here from the audience. Anybody has any last minute questions, shoot them in the chat, Q&A. But I think Matt and Burton kind of hit on a very similar point, which is how we'll close out here. It still seems a little pie in the sky. I'm going to push back on this a little, guys, okay? Seems a little pie in the sky to think that everything's just going to come back to normal, okay? And we've got government printing money and giving it out to businesses and people, and that makes it very easy to. There's government support is definitely fueling a fiery and an already fiery economy in terms of various asset classes, both real estate and. So, with that in mind, what hurdles do we lie ahead? What could happen? What happens if, as the government money stops, as the with all this growth and government support coming, the real question is, are we in a bubble? Gideon, you're first. I got to give you the tough one.
First. I don't know. I mean, look, I don't know. I'll be honest with you guys. I mean, in my world, there's only a few things I think that are going to affect, buying or selling multifamily, and I think interest rates are one of them. So I'm always trying to pontificate or hypothesize where interest rates are going to go. For me, as if interest rates go up, which eventually I think they have to at some point, I don't know if that's 12 months or 72 months from now, I think there's going to be a disparity between what we can buy for what and what sellers want to sell for if they believe that they can sell for. So I'm always mindful of a potential period of time where it just doesn't make sense to buy anything, and we'll have to pause. And
but if valuations are already 20% higher, I mean, I don't know if that's true in multifamily. I know it's true in residential. I mean, you go into Florida, we put a property on the market in Singer Island last week on Friday, 20% above where we valued it a year ago. So we valued it at $3 million. We put it on for 3.6, and in 4 days we sold it for 3.8, no contingencies.
I happen to have a property on Singer Island myself.
Oh, you can
where
sell
I'm
it
sitting right now, which is pretty funny. But I think that I'm not a cap rate buyer. I love buying at high cap rates, but ultimately that's based on what the last guy has been, how he's been operating, he or she. So, it's, for me, it's all about, do I believe that there's value to add and that, I can manufacture the yield that I'm looking for based on my management capabilities and the current interest rate environment and the cost of my equity, right? So that's what I look at, and that's how I've had to look at the majority of my acquisitions over the course of the last 5 years, because, I did a lot of real estate before GSH was formed in 2017, but when we formed GSH, people are like, are you sure you want to buy multifamily? We're at the top of the market, right? And that kind of freaked me out a little bit, but I'm glad I didn't not buy. I'm glad I still bought, right? Because we weren't at the top of the market. So
right, go figure.
I think that, our subset is workforce. We provide housing to essential workers, and there's an affordable housing shortage in the United States. And so we're buying a finite asset class, that you cannot build new and put a nurse or a janitor or a police officer or a fireman in a lot of markets across the country because of the cost of construction, the cost of land, the cost of materials. And so I think that we're well positioned as a niche to continue to be able to find opportunities for ourselves and for our investors.
Good answer. Good answer. Eric, you're shaking your head. Talk to me. You agree, obviously.
I'll give you, to your point of all of the government money being printed, I'll give you an example in the hospitality space. perhaps an unintended consequence is that, hotels and restaurants and anyone in the industry are having trouble right now actually attracting employees or getting their employees back off of furlough and back to work, because they're making more money by not working and staying at home. And so they're having a real difficult time attracting good talent. And that's an issue. There's the issue that we spoke about earlier of rising construction costs and shipping costs, and overall margins are kind of tightening, and these additional costs somehow need to be passed on to the guests or the owners or whoever is involved. So I think there are a lot of variables kind of outside the direct circle of what we're considering that could lead to different consequences, or use the term bubble later on, that I think it's all interrelated, and I don't think we're in a position to know yet.
Right. Doc, what do you any chance for a bubble, man? I know you want to be optimistic, but come on, what's the pitfalls? What do you think?
Let me explain in a very simple physician's term. So I have a patient who is doing great, okay, and suddenly gets pneumonia. So he comes to the hospital and I intubate him. I put him on oxygen, and the machine breathes for him, and everybody says, "Oh my God, whether he's going to survive or not." But I keep pumping oxygen, keep pumping antibiotic, all that kind of stuff. He gets better and he gets back to normal. And that's exactly what has happened to our economy. We have a very solid economy to begin with. We had COVID, we had pneumonia, we are pumping money, we are doing all the other stuff. And when things get better, that same patient is going to be just fine. The beautiful thing we have, and what we are missing, we are different than the rest of the world. Rest of the world is going to feel the impact. Because I am basically from India, India has gone back, in my estimation, and I'm sure somebody's going to criticize me for saying this, 25 years backwards for what they were just in this 1 year, because of the damage that's occurred to the economy. And it hasn't happened to us, because whatever we do is considered all right. Just like you said, if this money was printed and if the dollar wasn't reserve currency, we would be having a different conversation. So look at in terms of this patient, we have a very solid doctor. The doctor is doing a good job. And if anybody wants my presentation, Mark Seipert and partly me developed this presentation, how the economy behaves, is basically goes back to consumer confidence and job creation. If you look at it from 20% unemployment in April 2020, we are down to about 8%, 8.5%, 8.8%, depending on what you look at, which unemployment you look at it. And that also because of the stimulus money is coming in and people are not going back to work. So when that money stops, those people will start looking for a job. I'm telling you, I can employ 1,000 people in my restaurants today if they show up to work. And then it's just unbelievable because nobody's coming to work because they're making more money sitting home because of stimulus money. So that will go away. They'll come back to work. So Bill, I would love to have a discussion.
You might have converted me. You might have converted me right here, Doc. I love the illustration, and now I may have to be the optimist all of a sudden. The naysayer may go the other way. Thank you. I do appreciate that perspective. That's really wonderful. Laurent, I want to ask you a question. I want you to speak to what we're talking about in this topic, but there's another question specific to office space in the New York suburbs. Paul was mentioning that he was expecting a very tight supply, and that yet there is significant supply similar to urban space that when firms went remote. Do you think do you see a play in converting these larger office spaces? Have you guys thought about anything like that? Any thoughts on the panel about a conversion if supplies of office in the office arena do pick up and there ends up being less usage, like some believe? What are your thoughts on that, Laurent?
Well, again, I'm repeating myself, but the distinction between suburbs of New York and suburbs of Cincinnati, for example, we in our markets, when we buy for such a discount to replacement costs, we essentially position ourselves as a very affordable alternative to companies. And what I mean by that is You know, the cost, the amount that a landlord would have to charge in rent to justify new construction in our markets just doesn't add up. So you're not seeing a lot of cranes in our markets because rent would just be too high. Now, of course, you'll have some standalone or a build to suit or something like that, you know, offshoots. But if we're charging $25 a foot in rent and new construction would have to charge 35, there's nobody who's gonna bite there, because it doesn't add up for them. So no, we don't really see any need to convert because there is no oversupply in our markets. That's part of our due diligence, is we don't want to end up being flooded. And actually, when we buy at such a low basis, we can during hard times, we can undercut market rents and still be cash flow positive because we bought at such a low basis. And that's something that we can definitely do to go on offense in our markets. And just want to add one thing to what we were talking about before with respect to free money. I mean, I can't speak for the other asset classes, but I know for us, the government subsidies to help corporations pay for their rents, that expired back in June or July, if I'm not mistaken. So we were definitely, you know, it was a bit of a cliffhanger for us to say, okay, you know, when is this gonna run out? And then of course, lo and behold, come June, July, August, our rent collection is still over 95%. So we kind of breathed a sigh of relief and said, all right, you know, corporate America is still doing well, especially in our markets. And you know, if you look at, like, I'm here in Montreal in Canada. If you look at what's happening here, I mean, you want to talk about a bubble. I'll give you a quick example, then I'll move on. I know we're short for time, but the average home price in Canada increased by $65,000 last year, which is higher than the median income. In other words, people can't afford the homes they're living with. The unrealized gains in people's homes last year in Canada is bigger than the whole economy of Canada. So, you know, you want to talk about a bubble and something that's going to give that I would look at Canada. Vancouver is the most expensive city in the world. It's a scary place here right now.
So if you're in Vancouver, sell your real estate quick is the closing comment from Laurent. We have more questions. I'd love to talk all day, but I want to keep Mike and Jeremy on. Gentlemen, if you could jump in the Q&A after we get off here. There's even in the answered tab, there was something from Sam McNeil that somehow got popped back there. He's asking about cannabis data centers, some of these sub asset classes. And if any of you would like to type some answers in, I think that would be helpful to our audience. But other than that, I want to thank you guys, Gideon, Laurent, Eric, Doc Sangani, great group. Let's do it again next month, where maybe we didn't even get to opportunity zones. You know what? I'm going to get you guys on my webinar for an opportunity zone conversation. We'll talk about that next time. How about we hand it back to Mike? Thanks, everyone.
All right, Bill. Thank you very much. Thank you to all the panelists. Thank you, Laurent.